2024 is just about over and property prices are moving backwards in our two major capital cities right now. We're going to do an end of year wrap and uncover what happened to property prices in Australia in 2024. We're also going to cover the 4 key themes that drove prices and the rental market here in Australia using CoreLogic data. Let's get straight into it. So on prices, national house price growth has all but flatlined. It's really being driven by Sydney and Melbourne here. Check out this chart that shows the 12-month capital growth rate in Australia at the moment. You can see it coming down fairly quickly right now. You've got capital price growth at around 5.4% for the year and 6% in the regionals. This is heavily weighted to half one 2024, with prices coming back down in the latter part of 2024, with Sydney and Melbourne actually going into decline, and that's driving that weighting back down. So this is the national index that aggregates housing markets all across Australia and calculates what happened in 2024 versus what happened in 2023. You can see growth rates starting to come back down, roughly 5.4%. A pretty strong year for housing in general. Quarter by quarter, this is where you start seeing the most recent changes coming in. It's at 0.3% right now. And perhaps by next quarter, the national index will be moving backwards too. Sydney and Melbourne obviously have the largest weighting in there, but Perth, Adelaide, Brisbane, the other major markets, they are rising very strongly, but the growth rates are coming back down too. So that's the general story that we have with house prices in 2024. But what's driving this level of price change and the slowdown in house prices? Let's go through the 4 key themes in the housing market in 2024. Okay, so theme number 1, cheap properties did very well, expensive properties did less well, and sometimes did really badly too. This is the 3-month growth rates for different quartiles of property in each capital city. So we have the bottom 25%. That's the most affordable segment of the market where most people are actually participating. You know, in Sydney, probably the sub $600,000 mark, different levels in different areas, but the areas of the market that most people can actually buy. And the top 25%, that's the most expensive stuff in each city. How is each different market performing? And what you can see is pretty much uniform across each capital city. You have Sydney house prices moving backwards in the more expensive areas. The eastern suburbs, the inner north, the CBD areas, they're moving backwards at quite the clip, negative 1.6% this quarter. If you aggregate that up, you're probably down nearly 5% this year, and it's accelerating too, so the house price falls could get even larger in these areas. This is starting to spread all across the market, but you can see the bottom end of the market is actually doing pretty well, up 1% this quarter, 0.9% in Sydney. You have this same story everywhere you look. These yellow bars are doing better than the orange bars in every single capital, except the ACT, where it looks like the cheap properties are doing poorly. Other than that, everywhere else, affordable properties held their own, did better this year than the more expensive stuff. Why? It's because we're 2 years into the high interest rate environment. People are being crowded out. There's going to be more and more demand pushed away from expensive areas because people can't borrow enough, or they simply don't want to borrow that much money, and they're being pushed into areas where they're taking out smaller loans. Perhaps they've got smaller borrowing power, and perhaps they can afford less, and that's why more demand is being pushed into more affordable areas, and that's driving activity up. You're getting the normal buyers that would buy there, plus buyers who would typically buy in more expensive areas are now buying in cheaper areas, so everyone's congregating around the cheaper areas. Plus, you have the second theme, the rise of the investor. Investors have come back into the market in droves in 2024. This is what I call a big surprise, something that I would not have expected to happen. But investors have woken up in 2024 and been like, I think I want to buy an investment property. Don't know why that's happened in 2024 with interest rates so high, but perhaps people are like, hey, I've got some savings built up over the past few years. What do I do with it? I'm feeling a little bit more confident. Perhaps it's the younger generation because the data's sort of suggesting that it's first-time investors that are really coming into the market and replacing a lot of those older-time investors who are actually selling their properties to new-time investors. What crazy 2024 theme that is. I don't think anyone would have predicted that, but the rise of the investor is really, really strong. I can see it in this chart here, the investor lending chart that has the data set that shows how much investors make as a percentage of the market. And when I look at this chart, it's like really, really high. 38.3% of the market is investors right now. The long-term average as to what investors make up in the marketplace is around 33%. And if you go back 2 or 3 years ago, man, it was down near 20%. That's like double the percentage of the overall market inside 2 years, 2 or 3 years. That is a huge change in the marketplace as to who is buying. Investors, watch out, because what happens sometimes in marketplaces when investors come in and when there's too many investors, the politicians go out there being like, I'm going to protect the first home buyer, I'm going to protect those home buyers. There could be a little bit of an anti-investor sentiment that pops out into 2025 as this data set keeps making its way through into the media headlines, and it's like, hang on, investors are everywhere, they're buying up all these properties, they're causing problems. That sentiment can rise when there's too many investors, and that's happening right now. The data is pretty clear. And we see this speaking to investors all across the country. There is more urgency, there is more activity. Investors are going out there being like, I really want to buy something. There's FOMO. There's investor FOMO at the moment. I don't want to miss out. I want an investment property. You wouldn't think that's the case. That's so weird. Interest rates are so high. Cash flows are negative. In Brisbane, you're getting a 3.6% yield. If you buy a property, you're losing tens of thousands of dollars in Brisbane just for buying that investment property. You would think, hang on, there'd be no investors in Brisbane. In Adelaide, it's the same story. In Perth, today, it's the same story now if you're trying to buy. But yet, investors are like, hang on, yeah, I want to buy. I'm happy to lose tens of thousands of dollars a year because I believe in the capital gains that are coming. So it's a very, very strange story to have interest rates this high while investors are looking at the equation being like, I really, really want to buy. But that's what the data is. That's the summary of 2024. We've got theme number 3 here is that rents have stopped rising. We've done another video on this where we said that there's cracks appearing in the rental market and the rising rent story over the last 3 or 4 years that has dominated the headlines, that is starting to go away. We have rental price growth really nosediving from double digit. Some areas were like 15% last year, and now they're being revised down to like 2% for 2025. That is a big, big change in the income story of property. If rents go up, the income that property investors get goes up too, and that helps cover the higher interest costs, etc., etc. It makes it more attractive to invest in property. It's like, yeah, I'm making a bigger return. Hell yeah, I want to invest in that. But that story has stopped. It's pretty much a national story, but in Sydney and Melbourne, you're seeing it very much on the ground. You're seeing it all across all of Australia that the rental growth story is coming down as well. So we've got a couple of charts here to show you what's happening with rents. You can see that here. This is that big steep hill down. It's like, oh, you'd expect a gradual decrease in the rate of growth, but nope, it's like, whoo, we're going down that roller coaster. We rode us up to the top, and then out of nowhere, it's like, down we go. A little bit scary. I went to Disneyland this year, and that was what I feel when I went on that roller coaster, and that's what we're seeing in these rental charts. Good news for renters all across Australia, because the rental growth story over the last few years has been the underlying reason why Australian living standards have kind of went backwards, and we've had a deterioration in, household spending levels and the general feel in Australia. The cost of living crisis is really driven by the rental surge that happened, and that's going away. It's pretty clear. You can see this big downward trend in this chart here. Bring it down nationally a little bit. Perth rents up 9%, Adelaide 7%, Brisbane 3.6%, Melbourne 5%, Sydney 4%, Canberra, Darwin under 3%. Pretty healthy sort of amounts here, but something that we can actually stomach a little bit. Like, kind of sucks if you're in Perth and getting a 9% rental increase, but compared to the year before, it's like double digits. It's like 15, 20%. And in Sydney, it has been that for a number of years. It sucked, but now that's coming down, that's going away. Rental yields as well is a different story as well. Rental yields is in and around that 3.5% range in Adelaide, Brisbane, Melbourne. In Sydney, it's at that 3% range. Perth, Hobart, around 4.3, 4.2%. The Perth story is actually really interesting when I look at it. It tells me that there's more room to run for prices. As crazy as that sounds, because Perth has dominated house price growth over the last few years, there's more room to run because it's getting a higher rental yield than Adelaide, than Brisbane, and it sort of suggests that there's potential for prices to continue to rise there. Darwin yields at 6.8%, very, very strong there. Finally, the last theme that we have, and this one is an unfortunate one, is we are not building enough homes yet. Thankfully, we can add the word yet right now. We have approval numbers finally starting to increase a little bit. We're seeing the sliver of hope that we're going to start building homes in Australia again. The latest release in October shows a big upward trajectory in the approval rates here in Australia. You can see this on this chart where we've got our approval rates here. We're at the decade average level for the number of houses being approved, and for units, we are well below average here as well. So there's not enough homes being approved, so there's not enough homes being completed. You're going to see that because population growth rates in Australia are really, really high right now, and they have been for the last couple of years. And if we're building the same number of homes as we have done on average over the last 10 years, the problem's just going to get worse and worse. But it looks like that approval trend rate is starting to go up. And all across the country, at every layer of government, you have government saying, we need to build more homes, supply, supply, supply. You have state governments rezoning land and coming up with package after package to try and get this done. You're going to see through 2025 an approvals boom start to come through. It might take into 2026, but that's the end of this "we're not building enough homes" story that we have, but it is a key theme of 2024. There you have it. The lay of the land, the full summary of prices, and the 4 key themes of 2024. In our next video, we're going to go through state by state and work out what actually happened in Sydney, in Melbourne, in Brisbane, in Perth, in Adelaide, and go through the story of 2024 state by state. And if you could all do me a favor, if you're still here, hit that subscribe button, drop a comment below, and I'd be happy to answer any questions you have.